Investing in stocks can often seem like a long, slow process, but what if I told you that many short-term trading concepts can be adapted to enhance your long-term investment portfolio? I am Willem, and today I will show you how. Before we dive in, make sure to subscribe and hit the notification bell so you don't miss any of our future content. Without further ado, let's get started. First, let's discuss the benefits of combining short-term trading concepts with long-term investing. Short-term trading strategies can provide valuable insights into market timing, risk management, and trend identification. These are all crucial elements that can improve the performance of a long-term investment strategy, as you will get more precise entries with a solid risk management plan. In short-term trading, timing the market is everything. Day traders use various concepts to determine the best places to buy and sell, while long-term investors don't need to be as precise. Incorporating some timing elements can help to optimize entry and exit points. For instance, volume profile support and/or resistance levels can help you decide when to enter or exit a stock. Would you have entered here to buy Microsoft stock to your portfolio if it would have been the year 2022? Let's assume that you had a bullish outlook on the company. Well, I would have, and this is not cherry picking. The volume profile is a powerful tool which I use on a day-to-day basis for my long-term stocks portfolio and also when swing trading with options. The volume profile itself is an analytical tool used in trading that displays the volume of trades executed at various price levels over a specified period. Volume profile provides a visual representation of where trading activity is most concentrated. This helps to identify key support and resistance levels where significant buying or selling has existed historically. If you will go check out the volume profile historically or live on your favorite stocks, I will guarantee that more often than not, the high volume levels are respected. But bear in mind that when the higher volume loads are not respected, you bring the average entry price down on the stock you wanted to buy anyways, so incorporating the concept into your investment portfolio might be a good idea. Managing risk is another hot topic that short-term traders must get right. We set stop-loss orders to limit potential losses. Long-term investors can also benefit from this approach. By setting trailing stops or predefined exit points, you can protect your investment from significant downturns while still allowing for growth. Additionally, you won't have to see your stock position go 100% when in about a month it is back to break even without taking any profits. Personally, for me, this feeling made me change up my risk management rules for my long-term investment portfolio. So I'm speaking from my past experiences here. I use a fixed stop loss and take profit levels determined when entering the position and also a trailing stop with a 25 exponential moving average. I close the position when there have been 3 consecutive candle closes under the 25 exponential moving average. This approach only works for more volatile stocks that have had a big run upwards. For dividend and slowly growing stocks, I prefer to stick to a fixed stop loss and take profit levels. Therefore, risk management is more often subjective than I wish it to be. Short-term traders must be precise with their trades, which is why we look at market trends using technical analysis. The same approach can be used by long-term investors, as the stock market is typically nearly more than a year already priced in. I was taught this circumstance in one of the major investment banks in my region, and I have seen it live multiple times in my investing career. In the end, everything is priced in, although my belief is that the lower liquidity markets, such as the Eastern European markets, are not as effective as their American counterparts, such as Nasdaq or the New York Stock Exchange. Therefore, seeing price rallies in a stock before major news has appeared might most definitely indicate that the sector and/or the stock will soon have major good news releases in terms of the company's sales or the company's outlook growth. One of the ways to spot early rallies happening is by checking out the market structure on, for example, the weekly time frame and finding potential breakouts in terms of price and structure. Market structure itself refers to a shift in the underlying trend of a stock, signaling a potential reversal. It is a key concept in technical analysis used by traders to identify pivotal moments when the market transitions from a bearish to a bullish trend or vice versa. These changes are identified by patterns such as higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. For long-term investors, understanding the market structure changes can provide an early indication of significant shifts in the market sentiment, helping them to align their portfolios with the prevailing trend and improve overall investment performance. Let's go over an example on the Adobe stock when the AI Photoshop hype was not even a thing. The stock bottomed out perfectly on the high volume profile area, changes the market structure to bullish. This is a clear sign of a valid setup for a long position on the Adobe stock. Additionally, this approach would have gotten you into the trade before anybody else, although from the entry you must choose where to exit and why. The exit approach will always be unique to everybody because we all have different objectives, goals, and everybody is different in coping with volatility. I myself can take higher risk than a typical investor, which comes from my day trading background. Therefore, I often also trade out of the money options with the same exact stock strategy. Bear in mind though that the market structure shift should not be overestimated. It does not work all the time. I would even say it does not work most of the times as a trend change signal. Therefore, you must use it with a confluence of another concept, for example, the volume profile. Now, let's look at the practical example using the three concepts we talked about previously. We'll use the volume profile for entering the trade, we'll use the take profit and stop loss to manage risks, and we'll use the market structure concept to add a safety guard to our volume profile signal. Suppose you're considering investing in a tech stock, in this case a cybersecurity one, for the long term. By using the volume profile, you can identify the best times to buy the stock by pulling the volume profile from the last bull run. From which price or prices would you buy the stock? I would average down my position with 4 buys, while I will put the highest percentage of the position size to 100 USD's order, as that is the highest volume node, also called the point of control. Choosing to size up entries comes from experience and the importance of the stock going into deeper discount, as well as previous high volume and luck. In this example, I was right, and I was right also investing into CrowdStrike on a live account more than a year ago, before all the cybersecurity sector boom. From the live account on Interactive Brokers, you can see that my average entry is 132 USD because I added on the way up, as it was a high conviction investment. In today's prices, the position is more than 150% up from the entry, which for an unleveraged position is quite a lot in a year's time. While the volume profile is the foundation of the strategy, I still use the market structure change concept to get the bullish sentiment on top of the fundamental analysis, as when the high volume profile node was hit, the market started to trend upwards, giving me conviction that the stock would rise rather than not. Additionally, I respected my risk management rules in case the investment would turn south. I had a fixed stop loss level, and per my take profit rules, I have already started to size down on the position. Although I'm not closing the full position until the 25 exponential moving average, trailing stop loss has been triggered. And with that, thanks for watching this episode on using short-term trading concepts for long-term investing. And if you found this video helpful, please like, subscribe, and follow us on the social media linked below. See you next time.